afternoon. I'm Patrick South, Vice President of Development at the Chamber of Digital Commerce. For those of you that are unfamiliar with the Chamber, we're a nonprofit trade association focused on promoting the acceptance and use of digital assets and blockchain-based technologies. You can learn more about us at digitalchamber.org or by contacting me at patrick@digitalchamber.org. It's difficult to ignore increased client interest in digital assets given the global macro backdrop. However, financial advisors face many difficult questions when considering portfolio allocations towards digital assets. We're thrilled to have you join us for the second event of this three-part educational series geared towards financial advisors around digital assets. We held our first event last week around why now is a great time to focus on digital assets as a necessary diversification tool. We have our final event next Thursday at this same time, 12 p.m. Eastern, on what current investment options exist today and what future investment options may look like. In today's session, we have a really impressive group of industry leaders who will deliver an overview of the regulatory and compliance landscape, dispel several myths, and provide key considerations for you and your clients. If you have questions, I encourage all of you to use the Q&A function, and our speakers will try to address them throughout. We had some really wonderful questions last week, and I expect that to persist through this session and into next week. With that, I'm going to get out of the way and turn it over to Anthony Tusakine, Head of Seward & Kissel's Blockchain and Cryptocurrency Group. Anthony, over to you.
Thank you, Patrick, and welcome everybody. Very excited about today's panel. Today's panel will focus on regulatory compliance issues that investment advisors will need to know if you do decide to invest in cryptocurrencies for your clients. Obviously, I think this is a very timely panel. I think most people probably saw yesterday's announcement by PayPal that it will allow its account holders to directly invest in Bitcoin and a few other cryptocurrencies, and also at some point in 2021 will allow payments to be made with these with crypto assets. So very exciting. And of course, there was an immediate pop for most cryptocurrencies, particularly Bitcoin. So if you look at Bitcoin, I think year over year is up like 80%. Obviously alpha that you can't find other places. So I think it's been a very exciting investment asset class for a lot of people, and we have a great panel today with people who have been in the crypto area for quite a while. Seward & Kissel is a financial services law firm, and we have been, I've been following cryptocurrencies for way too long. But we formed a cryptocurrency group about 5 years ago and have been working on regulatory and transactional issues that relate to cryptocurrency. I would like to give our panel members a few minutes to introduce themselves, and then we'll jump right into the matter. Matt, you want to go first?
Sure, thanks, Anthony. So Matt Trudeau, I'm the Chief Operating Officer at ErisX. ErisX is a CFTC-regulated futures exchange and clearinghouse. We also have a spot exchange and clearinghouse for cryptocurrencies, currently covering 4 cryptocurrencies in the spot market: Bitcoin, Bitcoin Cash, Litecoin, and Ether, and listing contracts on our DCM, which is our CFTC licensed exchange for Ethereum and Bitcoin. We are to date the first and only CFTC regulated futures exchange to offer contracts on Ethereum. Our contracts are also physically settled, which is a little bit different than some of the other contracts that are available in the market, meaning that at the time of settlement and delivery, the actual underlying cryptocurrencies are delivered into the accounts of clearinghouse members.
Great, thank you very much. Sydney?
Hi, thanks Patrick and the Chamber for inviting me to speak here, and thank you Anthony for moderating. I'm Sydney Schaub. I am the General Counsel of Gemini Trust Company, which was founded by Cameron and Tyler Winklevoss in 2015. And we are a New York DFS registered limited purpose trust that also acts as a spot exchange and custodian for a range of cryptocurrencies Bitcoin, Ether, Zcash, Litecoin, and many, many others.
Okay, and a great website that is very easily usable. I speak as a long-time user myself, so big fan.
Great, we love to hear that.
Tom?
Yes, Tom Lombardi, Managing Director of 3IQ, based in Canada. We have main offices in Toronto, but we also have offices in Montreal and now in British Columbia, Vancouver. 3IQ, first of all of my thoughts are my own, not of my company's, and none of this is investment advice. The advisors certainly understand the disclaimers. So our flagship fund is called the Bitcoin, trades on the Toronto Stock Exchange, ticker symbol QBTC.U is the USD denominated version. And we just went live trading today with our Canadian version, which is QBTC. We are also, so that's our flagship. We just surpassed 100 million in AUM. So big milestone for the team. We're really proud of. In terms of other products, we have a preliminary prospectus on the Ether funds. So this would be a similar format, but with the Ethereum native token Ether. For accredited investors, we have the Global Crypto Asset Fund. Really excited to be here. You know, the Chamber does wonderful things for our industry in terms of awareness, bringing people together like we're doing today. And, you know, thinking about talking about advisors and exposure to Bitcoin is like my charter in my career. So honored to be here with you guys.
Great, thank you very much, Tom. And last but not least, Will.
Hi, my name is Will Coleman. I'm a director of technology advisory services with Cohen Company. Cohen Company is a full-service accounting firm. We place about top 50 as far as general size. Although we have a pretty heavy specialization, we are actually the 5th largest auditor of registered investment funds, surprisingly enough. We were an early player in the space. I mean, we've literally issued a couple hundred audits that are cryptocurrency only. We've issued SOCs, you know, type 1s, type 2s. We did the first stablecoin attest. We really committed very heavily to this space very early. You know, we're just really happy to be on the panel, happy to provide any help we can, and you know, just a really great panel to be on with. So feel very honored.
Yeah, and you know, I've known Will for years now. Cohen was, as you said, one of the earliest accounting firms willing to be auditors for crypto funds and the crypto exchanges. So that's you know, you have some, you know, definitely an early entrant. So so today's panel, we're trying to focus on regulatory you know, considerations for financial advisors, and a couple of the risks that we have identified. I think that every financial advisor should consider, you know, when you enter into space is, you know, is suitability and liquidity. That is, you know, obviously, you know, is this a kind of investment that works for your particular investor, but also, you know, what is the liquidity of a particular cryptocurrency that you might be interested in. There is a lot of uncertainty in regulatory risk, and we'll talk about that in a little bit. But you know, one of the questions, at least in the United States, that dogs many of the cryptocurrencies is you know, what is it from a regulatory perspective? Is this a security? Is it a commodity? Is it something else? And you know, with the exception of you know, maybe the big top 3 or 4 cryptocurrencies, where we know the SEC has, you know, told us multiple times that it considers Bitcoin and Ether to not be securities. Many of the other cryptocurrencies, you know, there have been no official announcements. So you know, that's certainly something that needs to be considered. Custody is a huge issue, you know, not only on, you know, from a practical perspective, but also if, you know, if you're an advisor that needs to comply with the qualified custodian rule, you know, is your custodian a qualified custodian for that purpose? Or frankly, you know, do the cryptocurrencies fall into the kind of funds or securities, as the rule says, that actually needs to be custodied with a qualified custodian? Audit and verification, clearly that's something that Will can talk a lot about. but the quick, the question is there really a there there? I think, we've all read the stories in the paper about, cryptocurrencies or players in the crypto space that profess to have assets. And, once an audit is done, it turns out that there's a significantly different picture than the one that the issuer or the player painted. And then legal and exam risks. By now, the existing crypto funds that invest in crypto have gone through, 3 or 4 cycles of SEC exams and audits. So, you probably will not be surprised for those of you that are financial advisors that the audits really follow along the same lines of your regular audits for non-crypto funds, with a crypto overlay. So there you will have questions about custody and risk assessment and so on. So let's jump right into it. Tom, is holding crypto directly really the best way to invest in crypto? Are there any challenges when you do that? Is it easier for me to go out Bitcoin, or to just go buy Bitcoin, or should I think about investing in one of 3iQ's funds?
Well, I think you've answered the question on your own, Anthony. But no, gosh, how do I distill this question down to only my allocated 8 minutes? It's going to be tough. I think first let's talk about the why Bitcoin cryptocurrencies. I think we've already surpassed that, right? Things like property rights, self-sovereign ownership, scarce store value. We're all good on that. But let's talk about the how, right? How do we collectively get exposure to, and let's use Bitcoin specifically as an example. So I look at this in 3 layers, of course: retail, managed, which is financial advisors and institutions. So retail is completely spearheaded, trailblaze. It's proven out. Coinbase, Gemini, all these firms that have had excellent tools. I call it sort of hot wallet plus plus. Local Bitcoin spot market, CME, BitMEX. All of these different avenues for anyone, regardless of suitability, to gain exposure to something like Bitcoin. All the tools are there. All you need is a driver's license and a wallet. So that is defined. That is maturing, and it's getting very easy. We see something like PayPal enabling transfers, acquisitions. I think the barriers to entry that people talk about are largely solved. Then we get into the managed capital, right? Some $30-40 trillion in the United States. Financial advisors. The quote I hear from a lot of advisors that I speak to is, I own it personally, but I would never put it in my client's portfolio. And that answer is not at face value, has a lot of dynamics, and it's really about incentives and risk management and compliance. It's not about like whether they think it's the right investment. It is the barriers, and let's talk about those, right? So another quote, Rick Edelman, figurehead of financial advisor. He's always said he believes in Bitcoin. He's very active. He founded the RIA organization, but he won't allocate client assets until there's a 40X product. That now we're getting into the why I don't put it into client portfolios. So let's keep going. Incentives, right? So let's first talk about effort, right? Effort. So advisors, they have tools. Tamarack, Schwab, all these client management tools that they use to make investments and to allocate. There's no Bitcoin option. It's hard. You don't access spot exchanges. Then we get into things like the CME. One, do you have access to that? 2, are you willing to roll over contracts and make sure that you have this ongoing exposure? And then 3, is it in their ADV, in their disclosure, to actually trade futures, right? And that's something that people sometimes shy away from. So, even something as remarkable as CME to come to market it's really difficult for that advisor market. And then, compliance. We can have things like custody, and Sydney can certainly go into that a lot more than I will. But how we move these assets around are so complicated. And we use 3IQ uses Gemini as a custody partner because we need these building blocks in order to facilitate our funds. And then at usability, this is something we talked about in the prep call, like user UI, right? User experience. It's hard. I mean, it's on many different levels. So how do we make it easy? In 3IQ, we sort of go with the ethos that we wrap a ticker symbol around custody products. And if we could do that on a efficient cost basis, we feel like we're adding a ton of value in the user experience for a financial advisor, in the security using a partner like Gemini, and then in the compliance. I mean, we're prospectus. The Bitcoin fund is a prospectus-based offering that trades on a major exchange, and we are in terms of asset-backed Bitcoin funds, we're the only one in the world. And then the other, I hit on institutions, right? What are the barriers there? So institutions kind of comes into three different buckets. One, we have these hedge funds that are largely playing the arbitrage in certain closed-end funds on the market, and ours may be one of them. They're not really taking exposure to Bitcoin. It's largely just gaining from the spread of the net asset value. Two, let's talk about other hedge funds that are trying to get exposure or is trading. So Paul Tudor Jones's fund, we have Renaissance Technologies. They are going through large efforts in order to disclose and in order to participate, but that's largely on the CME. So there's not that ownership. And then the last bucket is around like pensions, endowments, and insurance companies, right? They, that's the biggest barrier, around only prospectus-based listed securities. And that's why you're seeing them make investments, VC-style investments, right? We saw some endowments investing in companies like BlockFi. So there's a lot of hurdles out here, and I'm glad that we have, this panel today, because we're all in the, regulatory confines and offering things that are offering products that can get into the workflow of financial advisors. So, that's kind of backdrop. I've researched this a lot, and on the follow-up, I wrote a paper called Bitcoin Primer to Bitcoin Investment Funds on Medium, and I'll put that in the notes for Patrick to distribute.
Thank you. And one of the things I think that you may have not explicitly pointed out is like, if you invest in a fund like 3IQ, obviously it is let's call it a regular, just a share investment, right? I mean, you're buying shares in the fund, which is obviously something that already has all of the existing rails, so you don't really have to worry about investing in cryptocurrencies directly. Right. Well, thank you, Tom. Matt, I wanted to jump to you. When we had our pre-call, you talked about ErisX being an infrastructure builder, right? I know that you've gone through the very painful process of getting money transmitter licenses in most or all of the necessary U.S. jurisdictions. I as an attorney, I know exactly how much time and effort that probably must have taken. Is this a cost worth paying? I mean, clearly it's a cost, not just in money, but also in time to get ready. I mean, why should a financial advisor trade with, on ErisX versus another platform? I mean, if you go to BitMEX, for instance, you could get 100 times leverage if you so please. So why, what are the things that an investment advisor should think about?
Thanks, Anthony. Yeah, so look, I spent about the last 20 years in the capital markets, specifically on the electronic trading side of the business, and really the second half of that, the last 10 years, as a builder and operator of exchanges and alternative trading systems. And my first introduction to Bitcoin was back in 2014, and since that time, it's been really exciting to see how the market and the asset class has developed. But over the last few years, as we've looked at, I think as Tom mentioned at the outset, Bitcoin was really, and cryptocurrencies more broadly, were really a retail-driven market. And some of the early players, the early exchanges, there was maybe some questions and gaps around regulation. And obviously, we've got a number of the offshore exchanges that launched in either lightly or unregulated type of environments. I think what we're seeing more recently now with some of the actions from the CFTC and the DOJ is, and even foreign regulators, is that the time frame of those unregulated or lightly regulated offshore markets is starting to, that window is starting to close. That said, that there was an opportunity for a brief period there, and some of those exchanges did really well. They've also had their fair share of problems, and we've seen no shortage of issues with exchanges either being hacked or instances of the CEO being the only person who has access to and knowledge of the private keys. And if something happens to the CEO, suddenly people can't access their assets, or maybe those assets aren't even where people thought they were. So the team, myself included at ErisX, in thinking about the exciting opportunity that this new asset class presented, we took a very long view, and we had a couple of considerations in thinking about how and why we wanted to build our market. Number one, the US is one of the largest, most important markets in the world. And so our view was access to the US investors, institutional and retail, was a really important component to the growth and maturation of this market. If you want to access that market, you have to operate compliantly. And in our case, that really came in the form of two different compliance categories. On the one hand, to operate our spot marketing clearinghouse, we've had to go like Sydney's firm as well, to get all of the state-by-state money transmission licenses and the money services business license under for FinCEN compliance. And so we're now up to about 50 of those, including the New York State BIT license. So that was, I think, as you noted, Anthony, a very costly, very time-consuming, high-effort type of a process, but one that we thought was important in order to offer that spot market. In addition to that, we've secured the DCM, which is the Designated Contract Market License, and the DCO, which is the Derivatives Clearing Organization license, that allows us to operate a CFTC regulated futures exchange and clearinghouse. And once again, as market infrastructure builders and looking at the development and maturation of other asset classes and more traditional markets, we thought that futures could play and would play a very important role in the crypto markets and the development of the crypto markets, in terms of allowing different counterparties to hedge risk and bringing in new and more diverse players into the market. And then our go-to-market strategy was one of an intermediated strategy. So where a lot of the exchanges that first came on the scene went direct to the end consumer, because it was a retail-driven market, we wanted to expand to institutions, but also hopefully grow the pie on the retail side of the business as well. And one of the things that we thought was going to be important in that regard was to let a broader, more general segment of the population access crypto assets through an experience and interfaces that they're already well familiar with. So we have, for example, as investors, TD Ameritrade and Fidelity. TradeStation is a firm that's live and providing access to our platform today. And so, beyond those maybe cutting edge or forward-looking early adopter type of investors that were willing to open up an account, a new account, fund a new account at a new firm, we thought it would be great to make the asset available to the mass market in accounts and through screens that they're already looking at today. So as we've built out all that infrastructure, as we've secured these licenses, what does that provide? Well, again, unlike some of the spot-only markets, as a CFTC regulated exchange, we have a rule book and we have to comply with the CFTC's core principles. We voluntarily applied those core principles to our spot market. We have the same infrastructure. You can trade both spot and futures on a single platform, on a single market, and deposit them into a single clearinghouse. But we thought that taking the best practices from the regulated futures world and applying those to the spot market, in terms of surveillance and all the policies and procedures that we have around maintaining fair and orderly markets was a sensible thing to do. So we've really focused on building out an infrastructure that, from a technology standpoint, from an operations standpoint, from a compliance standpoint, surveillance standpoint, is robust and meets the standards that would be required by institutional investors, particularly those that are managing money on behalf of someone else. So early adopters in the industry, retail, people that are trading on their own behalf, proprietary principal trading firms that are managing their own money, typically very sophisticated. We just thought for intermediaries and for asset managers and those that are helping other people to access the market, it was critically important for them to know that they were trading on an exchange that had a surveillance program where the experience and the expectations would be very similar to that of other products that they're already offering their clients today. That's been our approach. It has been an expensive, time-consuming approach. We've been very methodical. We've been very collaborative with our regulators, and we've taken a slow and we think responsible approach, including launching at the outset without offering margin in our clearinghouse on the futures products. They're fully funded, so both the cash and the crypto collateral need to be in the clearinghouse in order to execute and then settle a trade. But in the future, and coming into 2021, we expect to launch margin. So we'll be able to offer margin eligible products like those that you might find on some of the other US futures exchanges. You're muted, Anthony.
Thank you so much. Thanks, Matt. You make an excellent point, and that is that financial advisors are fiduciaries, right? It is, they invest money on behalf of their clients. So it's a very different, if you are an individual or you are, do your proprietary trading, right? It's up to you to determine, the level of risk that you're willing to take. But as a fiduciary, obviously, it's a very different story. And thanks for making that point. So Sydney, speaking of being fiduciaries and making sure that everything is safe, what does a financial advisor need to know about custody? I mean, is it how do you choose a custodian? Do cryptocurrencies require a qualified custodian?
These are all great questions, Anthony, and I'm happy to speak to them, and I'll try to speak to them briefly. There's so much here, so much that we could go into and discuss, but at a high level, yes, custody is of course a critical issue with respect to digital assets, and an issue that from a regulatory perspective is continuing to evolve. And the question of whether a qualified custodian is required is a complex one. As this audience knows, and as Tom and Matt have both outlined, Tom in particular, there are many ways for a financial advisor to offer her clients exposure to crypto. And there are some ways in which I'm sure you all would like to offer exposure, like through an ETF here in the US or a registered 40 Act fund, that aren't really currently available. And custody, of course, is one of the issues blocking those initiatives, as the regulators kind of grapple with how existing law applies to custody in those contexts. So I will speak sort of briefly, generally, about the issue of custody as it applies to crypto, and then I'll go into a little bit more detail on what is required for registered investment advisors and others. And obviously, custody is an issue that Gemini has spent a ton of time and energy, like ErisX, as Matt mentioned, has sought money transmission licensing as required in all 50 states. Not all 50 states require it, but this is a burdensome process, and we have completed it. And have built really an institutional grade regulated custody. We're regulated by the DFS with respect to our exchange as well, but focusing on custody. We are a limited purpose trust company, as I mentioned, which is somewhat of a new vehicle that we work collaboratively with the DFS to create to regulate the custody of digital assets. And we have a custody white paper that sort of outlines our solution and sort of how it came to be. And so I'll share that so that Patrick can distribute it. I think it's available on our website. And we were actually created, Gemini was created by our founders in response to the Mt. Gox incident, because as many of you may know, our founders were early adopters of cryptocurrency and Bitcoin in particular, and wanted a safe place to store it and a regulated place to store it, and that simply didn't exist. And of course, as financial advisors, you will want a safe place to store your clients' assets. And sort of where is that? It's a great question. And it's it's interesting whenever I think about the custody, which is of course something we talk about and think about frequently. It's funny because financial asset custody really didn't win many headlines for good reason for like 100 years, because the technology around it, physical vaults and then electronic money, everyone got pretty comfortable with it. We understood the risks. And in fact, electronic money in some ways is less risky than in funds in a vault, because those thefts can often be reversed. So why should you and your clients be worried about custody in the context of crypto? And as everyone knows here, crypto is a bearer instrument, just like physical cash. But unlike a physical vault that has limited size, and it's sort of more challenging to take funds out of a physical vault, a digital vault is kind of the ultimate honeypot because it's elastic. So when you choose a custodian, you want to choose someone who has expertise in custodying a tokenized asset that's cryptographically signed with a private key. And that, of course, gives rise to unique technological, security, operational, and governance considerations, a lot of which Matt and Tom have already touched on. So the regulators, of course, are grappling with this. And can we use the technology that we have now for crypto, that existed, 5 years ago, before digital natives like ourselves started getting into it? And the short answer to that is no. So how does regulation keep up with this? And I'm talking, by the way, just so that we're all on the same page, about a central custodian holding assets on behalf of a number of clients, not like a private wallet. I'm talking about like a third-party custody solution and the regulations around that. You can, of course, custody your crypto yourself. Even I, who spend a lot of time doing that, am not comfortable with it. So you'll want to choose a third-party custodian. And why would you choose? How do you choose? I mean, I would submit, as Matt has, that you would want to choose a custodian who's regulated, because there are some regulations. Of course, not all regulators are the same in terms of how they've approached this, but there are some frameworks that have been adapted to apply. And of course, the DFS I alluded to, there's both the BitLicense framework and the limited purpose trust framework that applies all of the New York Department of Financial Services cybersecurity, compliance, and capital reserve requirements to crypto. So, like a lot of the sort of structures that could give you comfort around this, that ErisX has set out, those apply to Gemini from a custody perspective as well. And same with the money transmission requirements, and some FinCENS requirements. But from a custody perspective, specifically, the limited purpose trust is a really interesting vehicle, and one that we've embraced. And we've embraced all of the requirements that come with it, because we do want to foster trust in this asset class. We want investment advisors to feel comfortable custodying their funds with us. And the other regulators have approached this somewhat differently. The CFTC, Matt's already sort of outlined the CFTC's approach. The SEC is still very much grappling with this issue, and then the OCC recently, Brian Brooks, helpfully issued some guidance there, but even that has some limitations. So, okay, besides a crypto native custodian that's a limited purpose trust like Gemini, we also have a SOC 2 Type 2 report. So we have other external validation that provides comfort. banks, trusts, broker dealers, FCMs, DCOs have generally been deemed, at least in part, to be qualified or approved custodians under securities, commodities, and our banking laws. So depending on the type of what you're looking to do, the type of exposure you're looking to give your client, that might be as far as it goes. You can just choose a custodian that you feel comfortable with. However, if you're not a registered investment advisor offering a 40 Act fund and you're offering your clients exposure to Bitcoin and Ether, which are widely regarded not to be securities, but rather commodities, then it's not clear that a quote unquote qualified custodian, 40 Act qualified custodian is required. So you just choose a trusted custodian who's regulated in the same way. However, if you're looking to offer crypto in the context of a registered 40 Act fund, things get a little more complicated. We don't really have time to go into it in granular detail, but in 2018, the SEC issued the blast letter, which raised a number of custody-related questions in connection with the question, can a fund hold cryptocurrency directly? And these questions are sort of essentially still pending. Though there are some unique structures like closed-end interval funds, Grayscale, Bitcoin Trust, and others that have sort of sprung up in the gray area there. And of course, 3IQ is offering an exchange-traded product, and the Ontario Securities Commission got comfortable with it and got comfortable with the New York Limited Purpose Trust Company, Gemini, serving as a sub-custodian in connection with that product. So a lot more questions and answers here with respect to some products, but to the extent that you're offering your customers, your clients access to Bitcoin and Ether, other cryptocurrencies, outside of sort of the 40 Act structures, then you'll simply want to choose a trusted custodian that subjects himself to, I would submit, to regulation and has addressed the technological and governance issues that are paramount for this new technology.
Thank you, Sydney. And just for those of you who are not New Yorkers or don't deal in the New York financial space, DFS is the New York Department of Financial Services, and Gemini has the trust company charter underneath that, and it's regulated by the DFS. So thank you very much,
Anthony. If I could jump in just for a moment, there's actually just as of late yesterday, there was some interesting guidance that was issued that came out of the CFTC's Division of Swap Dealer and Intermediary Oversight with regard to this issue of custody. So one of the requirements under the CFTC is what's called segregated funds, where an FCM is required to, and a clearinghouse is required to segregate the funds of a customer from the funds of the FCM or from the funds of the exchange. And the CFTC's guidance clarified for FCMs in terms of the handling of the underlying physical cryptocurrencies, where what qualified as a depository, and of course a clearinghouse such as a DCO is, per this guidance, a good depository. So these are, again, I think as Sydney mentioned, the focus on custody and these topics, which is either historically to some degree been taken for granted, or definitely not has not been as interesting as it is today. Even this guidance just came out yesterday is really important guidance for the FCMs and for the adoption of the asset class in other contexts beyond just the retail spot market.
Yeah, and just to add to Matt's great comments there. The CFTC, of course, has been very much a forward-thinking, along with the Department of Financial Services, very much a forward-thinking regulator with respect to crypto issues and crypto custody issues. I have sympathy for the SEC. Where crypto is but one component of the broad set of things that the Commission needs to consider and make rules around. But we have certainly appreciated the thoughtfulness and the leadership coming out of the CFTC with respect to some of these issues. The SEC has been somewhat slower to engage, and we're working on trying to educate them. But perhaps as other agencies such as the CFTC, such as the OCC, start to get more comfortable with and promulgate additional guidance around crypto, we hope that will be inspirational to the SEC as well.
Thank you. What I find is to me as a lawyer very interesting is the different approaches that all of the different agencies are taking as well. State regulators actually, just like the CFTC, have been on the forefront on this. I think the state regulators have been way more active in the cryptocurrency regulatory space, I think, than federal regulators, with the exception of the CFTC, which was really early on has provided a lot of guidance. I know with the ACC, a lot of the questions really focus on the question of, custody and valuation and keeping things safe. I know that particularly on the trading and markets side of the ACC, there are significant questions that the staff is still wrestling with, trying to get comfortable with. Even where other parts of the ACC, like investment management and I think the Corp Fin people have gotten more comfortable with the crypto side. I think one of the reasons why we don't have an ETF in the United States that invests in in Bitcoin or any other cryptocurrency is for that particular reason. So, and
I'm sorry, I'd hate to take away from Will's time, but I also, because this is an audience, very well. This audience, we're talking about financial advisors, and everything we're going through is very insightful, but it's very very high level. I think if you go down to the actual financial advisors, right? Like if you're going to put Bitcoin from spot market to a qualified custodian into a client's account, you have so many things you have to do. You have to change your ADV to add this new asset that you are now exposing to. What is that? We did that at Wave Financial. I was a financial advisor, earlier this spring, and our audit starts on day one. When you add Bitcoin cryptocurrencies to your ADV, that's going to happen. Number two, know your customer. Is Bitcoin suitable for your customer? Maybe, but there's nothing in the series 65, 66, 7 that say anything about digital assets or Bitcoin. So you can't, to even be educated about the client and the asset, there are parts of that requirements that fail. Lastly, know your product, know what the asset is. How does it correlate to a portfolio? What are the risks to owning Bitcoin? All these things are daunting and in fact, maybe impossible for a truly compliant financial advisor. So I come back, we talked about this around user experience for financial advisor. Like, how do we simplify that process? And it's sort of the path towards 3IQ for me wasn't about it's not about promotion here. It was like, that's what I found the fit. The fit is to get through these hurdles around the usability, the compliance. And so, I love all of what's happening in regulation and usability and all of these institutional investors. But if we're talking about financial advisors, we still have a long way to go.
So I hate to continue to pile on Will's time here, but Tom makes some interesting points. And look, usability is critically important. As a customer-centric organization, you have to worry about usability. But in financial markets and with financial products, we also talk a lot about offering customers choice. And for me, I spent some time building a business that sought to digitize the trading of precious metals just prior to ErisX. And we often make comparisons of Bitcoin to gold in terms of it being a bearer asset. And we think about gold as an asset class. There's a whole bunch of different ways that somebody can get exposure to gold. They can buy physical coins from the mints and have them shipped to them and keep them in their physical possession at home. They can buy the GLD ETF and that goes right into their brokerage account. They could trade the futures product if they so desired. Or they could buy the gold, physical gold, and keep it stored in a depository. So Bitcoin to me has a lot of those same characteristics in terms of the ways that you can access the asset. And different people have different preferences. So somebody might want just price exposure, in which case maybe the futures product is good. Somebody wants the convenience of the ETF. Other people really, it's super important to them to actually physically hold the gold. There's an axiom in the gold market. If you can't touch it, you don't own it. And the cryptocurrency equivalent of that is not your key is not your crypto. So, there are these echoes to asset classes that are in fact pretty familiar and modalities of accessing those asset classes that are extremely familiar. And so for investment advisors who have customers that have asked about or dealt with gold in the past, you can think about Bitcoin in a very similar way. There are definitely some peculiarities and differences with Bitcoin or other crypto assets, but it may not be as exotic as you think. And being able to offer the choice is in fact a real option.
Thanks. Obviously one of the issues with cryptocurrencies, cryptocurrency funds, and other types of investments is to how do you verify that something is there, right? We all know, how if you hold custom assets at a bank and you get examined by the SEC, you can show them the bank statement, and that is considered the appropriate record. But when you have cryptocurrencies, well, how do how does somebody make sure that their cryptocurrencies are really there? I mean, what do events in financial advisors, what should they look for?
Yeah, so this is complicated because the joke that anybody's heard me speak on this a couple of times has heard is hey, it's a nascent technology that creates irreversible financial transactions. What could possibly go wrong, right? And that's sort of the situation that you're in. This is a fairly new technology, right? We're talking about the standard, we're talking about them evolving, we're talking about the processes evolving, and there's no arbiter in this case. And that's one of the big things to understand is there isn't somebody who can reverse this transaction as we're used to being able to go to court and have something reversed. That brings up a significant risk. And I bring this up just because I think it's very important to understand it, is that we always think, well, what happens if somebody gets inappropriate access, somebody walks off with your money, right? Well, actually, I haven't really seen much of that. And I've literally done I've been involved in hundreds of audits. What I have seen is people lose keys. This happens. People lose access to their crypto. Somebody else didn't take it. They just can't get into it anymore. And that's not necessarily a fixable problem. You may not be able to recover it. And that can be because a technological failure. I was literally sitting in the SEC office in San Francisco, trying to give them education on cryptocurrency. This is way back the day the Parity wallet failed, right? And they're like, yeah, they didn't want to talk about anything else. That was just that. But that was a perfect example of something that, we're sitting there trying to explain to them how we can audit this stuff. And there's the technological failure, right? And so there are other risks. So to mirror what other people have said is that this is daunting to get involved with, but in some ways, like I said, it is easier. So there's a blockchain, and this blockchain allows you to see what somebody owns. So there are ways that a custodian can show you what they are holding. This gets into a whole discussion of proof of reserve, and the digital chamber is working on it, has a big working group on this right now that I'm a member of, as it turns out. The issue here is, to me, is that it can change very quickly. So fine, you have an audit 6 months ago. Where are you today, right? There's a big time window that's changed. You're in a very dynamic space. So I can get into the technical indication, technically how you verify these things, but I don't think that's really interesting to our audience. I think what's interesting is like, hey, I'm new to this. I want to understand how to verify. And I think what you need to do is you need to look to see whether or not they have good internal controls, right? Do they have a SOC? Do they have other types of things? And this is going to sound a little self-serving coming from a company that provides the service, but who did their SOC? There are mills out there that will basically give you a questionnaire. You can sign off on it, or you fill out things and they'll sign off on it. They'll take that risk, right? They'll collect their 5, 10K, and they'll say, hey, you got a SOC, good enough for me. And those shops fold relatively regularly. You need to read that document or get someone on your behalf to read that document to determine whether or not it was really a thorough review. Same thing with the audit, right? Look into the audit, is how thoroughly was it done? There are, again, not calling anybody out, but there are companies out there that are doing them in a very cursory way. They're trying to carve out market share, and they're not doing these in a thorough way. So they're not as comfortable, for you. You may not get a full understanding of the risk, right? And it's not that they didn't have the audit done. It's just the risk may not be represented in a way that you're really getting your head around it. Again, I know that sounds a little self-serving, but the other aspect to me is that I think you have to do your due diligence on the people who are involved. Understand when they became involved in crypto, how did they become involved? Why did they become involved in this space, right? What is their experience, both in crypto and in traditional financial markets, right? Because what you're really doing in when you have a situation where you don't understand something personally, you are really going to have to trust somebody else. And I know trust is a terrible word in the crypto world, but that's what you're coming down to. And so if you're going to trust somebody, the only thing that we have is sort of actuarial history, right? We know what they did in the past, and that kind of leads you to believe in them today. So I think you have to look back and say, well, has this person, if this person was an academic and always studying this stuff and was very involved, and you kind of know that they're in the space not just because of profit motive, but because of academic drive. And I see very little fraud take place when you start looking at people with those sorts of backgrounds. I see very little risk. I mean, what happens is technical issues. In all of these audits that we've done, fraud is not something that's come up. Really bad internal controls, yeah, that's come up a lot, right? So I think that you need to look at that. Do they have experience? Are they used to being able to report this stuff in some sort of traditional market? And I think that's where the people on this panel, their entities, again, not to be self-serving, but you're going to have a lower risk profile. Somebody asked a question, hey, what's missing, right? We get this, we've heard a lot of this stuff before, what's missing? And, what I'm going to say is insurance, right? This is a big deal. People don't talk about insurance because it's so hard to get in this space. Who is underwriting this risk really? What happens if there is a mistake, and depending on the magnitude of the mistake. I know this gets a little bit off of your initial question, which is just, hey, how do you do it? But it also gets into who's the fund administrator, right? The fund administrator is literally, you're going to have to moderate your risk in other ways. So your fund administrator is looking at this data on a daily basis. Your auditor's looking at it once a year, maybe twice a year, in pre-planning and things like this. If there's an admin that's a lot of experience in this space and they're looking at this data on a regular basis, if you're talking about a hedge fund or something like that, they're going to be the first person to raise that alarm bell. The other, again, history, is this a fund that's had an audit before? If they haven't had an audit before, well, that's, again, you don't have that history. I'm not saying that doesn't mean that they're good, but it means that you just don't know. So you're going to have to work your way into that. The space is young. It moves fast. And the best description I can give that is a buddy of mine was one of the early engineers at Ripple. And he and I run a panel together. And we got off the panel after answering some very deep questions. And he puts his hand on my shoulder and he says to me, when did I stop knowing anything about this space? And I was like, if you don't know anything about this space, none of the rest of us do, right? And the point is that it moves so fast.
Yeah.
And so my recommendations really are, and I know that I'm getting a little bit, again, off the audit thing, is that you need to look at the people like are on this panel that have institutional entities, and they're going to be generally your lower risk things. They're going to be less alpha. Let me be really honest about it, right? If you want big alpha, right, you got to go to these guys that are doing really cutting edge stuff in DeFi and all kinds of stuff like that. They're getting crazy returns. They also sometimes just blow up. That's just how that works. And they're unauditable in many cases because they are so actively chasing whatever is new. There's no controls around this thing yet. There's no good reporting yet. There's no, they're so far on the bleeding edge. It's not the leading edge, right? But you can't do that with other people's money. It's fine if it's yours. It's fine if it's you and your brother, or it's a couple venture guys that are recognizing that, 90% chance we're never going to see this money again.
Yeah.
And they might get big hits.
The idea is not to invest in anything. It has a nice acronym like sushi or kimchi, right?
Yeah, well, exactly. So you start conservative, right? It's like anything else. If you're learning, right, start conservative. Start with the people who've already walked this road. Learn how it works. That's probably appropriate for you to be bringing people, retail, your customers into it.
Right. So I, in my experience, I mean, people ask me about how do I choose the right, put in your blank for service provider. In my experience, anybody who is not willing to answer your questions about how do you do compliance, how do you do this, how do you do that, what's your KYC, and that's a red flag, right? I mean, because I think anybody, who's been in the space who wants to be regulatory compliant is more than happy to answer all those questions, because you know what, we spent a lot of time and effort to become regulatory compliant. So. All right, we are, we don't have a lot of time for questions, but I want to, ask just one wrap-up question for everybody. It's like, if you had one piece of advice for a financial advisor, that is thinking about investing in crypto, what would that piece be? Sydney will let you go first.
Wow, one piece of advice, gosh.
One piece of advice. In 30 seconds or less.
Right, and I think it's consistent with what's already been said, and what Will just said is that you will want to seek a partner, a service provider who is reliable, because this is a fast-moving space, and it's hard to stay abreast of not only the technology but also the sort of capital markets and underlying financials of these things. So going with a trusted partner is critical. Also, just point out, I love Will's comment about who's actually performed your SOC. We used a Big Four auditor, Deloitte did ours, and it was a huge amount of effort, but we think it's completely worth it, and hopefully will give investment advisors comfort.
Okay, Tom?
Yeah, I would say financial advisors thinking about Bitcoin, listen to your clients, right? Ask them. What are they, the other thing I found is that many clients of financial advisors already have Bitcoin outside of their managed portfolio with their advisor. So it's a lost opportunity for advisors. So I would ask clients, ask if they're getting exposure, ask them questions, and then, we talk about all these different hurdles about know your customer, know your product, know the compliance. Yes, those are huge, but it really comes down to like, is this something? Is this something your client wants to do? Do you understand it? And once you have that connection, you can solve the bigger hurdles. Education and dialogue. I think that's where it happens.
Thank you. Matt?
Yeah, I'd say, in furtherance of the discussion about the private keys and choice, this theme that does sometimes emerge in crypto land about disintermediation and not really recognizing the importance of intermediaries, I would say, may not be appropriate for all and everyone. I sometimes draw this analogy where you may not necessarily want to be your own dentist, for example. And there are examples where working with a trusted third party that has had some sort of certification or verification of their skills and capabilities and has appropriate policies and procedures and must adhere to them, there's a good reason for those things. And so when the consequences of getting it wrong could be pretty severe, as it could be in performing your own dental work or managing the private keys, working with the trusted intermediary is often a very good option.
Right. Matt, I will seal that line if you don't mind for future discussion. That's fantastic. Will, you literally got 30 seconds. So
okay. Definitely don't be afraid to dip your toe in the water, and definitely take your due diligence very, very seriously.
Thank you. Thank you very much. Patrick, thank you very much for giving us the opportunity for this panel.
Wow, Anthony, appreciate you turning it back over. That was a lot to pack into 60 minutes here. Fantastic job moderating, Anthony. Thanks for keeping us on track. We're just a minute shy of the 1 o'clock mark. Sydney, Matt, Will, and Tom, thank you for joining us today and sharing your insights. I'm really hoping our audience found that conversation as stimulating as I did. For those of you on the line, we'll be making this recording available as an on-demand resource after today's event. So be on the lookout with an email from us with that link. I really appreciate all of you spending an hour with us. Some of you from last week carrying over. As a friendly reminder, we hope to see all of you at our final event in this series next Thursday, October 29th. which is our grand finale. I've pasted the link in the chat if you want to register and have not already. And if you're interested in learning more about the Chamber or you have additional questions following today's discussion, I'd love to hear from you. I'm Patrick at digitalchamber.org. I hope everyone has a wonderful remainder of your day, and thank you again for spending this hour with us.
Thank you, everyone.
Patrick, thank you very much.
Thank you. Thank you.